Hey everybody, this is Coach D with TackleTrading.com, longtime trading veteran and options expert, and I'm here today to talk to you about buying put options as insurance. And if you stay till the end of this video, you're going to have a really clear understanding of how you can use put options to insure your paper assets. And you'll also have an opportunity to like and share this video and subscribe to our YouTube channel so you can get more great video content. Now, a put option is a contract. What it is it gives us the right to sell an asset at a predetermined price on or before a predetermined date. And if we own that asset, well, that means that we can then buy that put option, which gives us the right to sell that asset at a predetermined price. So we can basically fix our risk because we can pre-reserve the right to sell the asset at a fixed price. Now, if you own the asset, that's called a protective put. If you don't own the asset, you can buy the put option to speculate on a stock price dropping if you'd like to. But in this case, we're talking about insurance. So here's an example you'll be able to easily understand on how a put option works. So we're looking at a chart of Verizon here. And Verizon, you're familiar with, is trading right here near $58 a share. So it's trading at $58 a share. And the concern is, well, what if that stock price fell? What if it went down, the market crashed, or they had bad news, or what have you, and the stock price sold down? Well, let's imagine it went down to $50 a share. Well, that means the price would have gone down $8 per share, and now let's imagine we have 100 shares. Well, if we had 100 shares and it went down $8, that means we would lose $800 on that asset. And a lot of traders will use a simple method called a stop loss, which means, let's say it went below $55 a share, they could just dump it and get rid of it, and that would limit their risk to $3. Well, let's look at that $55 price point. Well, $55 is an old ceiling, and that's an old ceiling, and maybe you're comfortable with the $300 risk that would give you if you had that. So again, about $300 risk on 100 shares. So you could be comfortable with that. Now, you could also be worried about if the stock price fell below that, you might want to get rid of it, or we could buy insurance to control and fix that risk. So I've taken the liberty here of setting up an example of a protective put, and here's the example. Down here, you'll see we buy 100 shares of Verizon at $58 a share. And when we do that, we have unlimited upside potential. We could make however much money that stock makes if it goes up. But this stock could, in theory, go all the way down to zero. Not likely, but possible. And here's that graph where you can see it dropping to $50, and you can see that would lose about $800. $800, that would be a rough loss. Well, here's what we can do. We can buy insurance here, and what I did is I went and I put on a put option, buy a single contract for a $55 put, and it costs us $2. Our insurance costs us $2. So that would give us, again, the right. We own it at $58. We have the right to sell it at $55, which means our risk would be limited to $3. But we spent $2 to do it, so we have $2 more risk. And when we own that insurance, we now have the right to sell it at $55. That right costs us $2, and that fixes our risk at $500. The market could crash tomorrow and go way down, and everybody could panic. You could have a huge sell-off, and you would still have the right, in this case until April, that's 129 some odd days from now, you would have the right to sell that asset at $55 for a nominal cost, and it could fix and control your risk. Now you have a much better understanding of how a put option works. Again, a put option is the right to sell an asset at a predetermined price on or before a predetermined date. And when you own the asset, it's used as protection or insurance. It gives you the right to unload that asset, to sell it, and to get paid that $55 price in this example, no matter what happens, and you can sleep at night knowing that. Now, if you enjoyed this video, make sure you click like and share down below there, and of course, subscribe to the Tackle Trading YouTube channel so you can get more great video content.